Welcome to the latest Facts versus Feelings, Take 5 with Ryan and Sonu. Sonu, we're back. We're going to talk about two things today in the next 5 minutes. We're going to talk about the surprise summer rally, why it likely has legs, and then the economy continues to surprise to the upside. We just don't see a recession coming anytime soon. I'll start things off, Sonu. The strength we've seen in stocks this year, up about 13% on the S&P as we speak here. That's really strong. When you look back in history, though, and you're up at least 10% for the year as of the end of June, which is not that far away, the rest of the year does really well, up a median of over double digits return, which is twice what your average year returns those final 6 months. Now, here's what you really need to know. When you're down the year before, like we just were, negative the year before, and then you're up at least 10% the first 6 months, those final 6 months, Sonu, do even better, and they're up 89% of the time. Wow. It's not a guarantee. That doesn't always happen like that, but it says that this momentum can continue. I know you're a fan of the idea of momentum. When we hear momentum for an investor, what does that mean, and why do you think it can continue this year?
I like momentum because it tells you if something is going up, it's more likely to continue going up, right? It's almost a concept of inertia, right? An object in motion is likely to stay in motion, right? If something's going down, it's probably more likely to go down too. We saw a bit of that last year, but coming into this year, the first 6 months have been strong. So in all likelihood, and your data, your research points to that, you're likely to be up. And I like momentum because momentum begets momentum, right? And even in the academic research, going back, there was this famous paper that talked about 150 years of data showing that momentum works, and we are 30 years after that. So now we could say we've got 180 years of data showing that momentum works, and your work has shown that too.
Yeah, last year momentum went the wrong way. We had a 25% bear market, more in small caps, more in tech. So just to think, we've gone up a lot, yes, since the October lows, but just because we've gone up over 20% from those lows, that doesn't mean we just have to stop going up. In fact, we think things will continue to go up, as we'll talk about from the macro and economic picture next. But I want to point out one more thing, Sonu. The Carson Investor Research Team, we think things are going to broaden out the rest of this year. What does that mean? Well, listen, technology did great this year so far. Communications done great. We think things like small caps, industrials, energy, maybe some healthcare, and what's the other area I'm thinking about, Sonu?
Housing as well, home builders.
Yeah, home builders. Just different areas that can do well as this bull market ages. It broadens out. That's a healthy sign versus just a couple different groups doing well. We think a lot of groups are going to do well the second half of this year. But one of the most important points to that happening, Sonu, is we need to avoid a recession. We need an economy that continues to expand and continues to grow, and those cyclical names will do well. Financials, that was a group I was thinking of earlier. Financials maybe do a little bit better as well. Those cyclical things, if the economy's strong. Sonu, what's kind of one or two of your favorite things from the economic point of view that say, you know what, there's no recession coming, and the economy could do better the second half of this year, maybe that they're not hearing about on TV?
Now, look, one thing connecting the stock market to companies, right, to the economy. Look, companies are part of the economy, and profits come from the economy, from people spending. And in the US, 70% of the economy comes from consumption, right? And if employment is strong, that means incomes are strong, and that translates to spending. But what I'm really excited or really positive and optimistic about, two things, right? One is housing, right? Last year, like, housing has been dragging on economic growth for 8 straight quarters, right? And we think that's at an end. Last year, housing pulled GDP growth down by about 1% or so. We think that drag is ending. That by itself is a big deal. But now what we're seeing is, housing is turning positive because home builders are seeing a lot of demand, because it's not enough supply of homes. That's simple as that. It's not enough supply. There's a lot of demand. Home builders feel like, you know what? We are going to start building again because we see end demand out there, right? Now, they're giving a lot of incentives and things like that, but they're positive on that. I think that's a big deal for the economy. The other thing is manufacturing. Now, we have a lot of manufacturing sentiment surveys, right? S&P Global, ISM, they go out and ask, manufacturing firms, how is demand doing? Are you seeing more orders relative to the last month? Are you, what are you seeing in terms of inventories, prices, things like that? Sentiment's been negative. But if you look at the hard data, right, the actual data, which in terms of production, that's really positive. And you look at manufacturing, especially in the semiconductor space, electric vehicle batteries, that's doing really strong. And look, companies are not going to invest unless they think that, demand is going to be strong, the economy is going to be positive. I think that's what I'm optimistic about.
There you go. That is the latest Facts versus Feelings, Take 5. The summer rally likely will continue, and the economy looks good. We'll see everybody next week. Take care.